Hey, accredited investors, I'm excited to announce that we have a new deal right now. It's a 78 unit building, 5 minutes from the Kentucky Derby. Its rents are presently 20% below market for renovated units. To learn more, all you need to do is go to homeinvest.com or click in the description below. Always consult with a tax advisor, financial planner, and/or attorney before making investment decisions. Having said all that, all you need to do to learn more is go to homeinvest.com or click in the description below.
Are you looking for passive investments but are worried right now about rising interest rates and the bank collapsing? If so, this is the show for you. His name's Nate Armstrong. My name's Steve Warner. He's the founder of Home Invest. I am the chief investment officer, and you are listening to Purpose-Driven Passive Profits. So this is the place for you if you are interested in building a long-term safe foundation. If you are a believer, if you're a Christian and you believe that we can make passive profits to build the kingdom that God wanted, as well as a safe foundation for us and our families, you are in the right place. If you're looking for Lamborghinis, private flights, things like that, you might want to check out a different podcast, but this is perfect. Blah, 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 blah. This is Purpose-Driven Passive Profits. Welcome to the show, Nate. How are you doing today?
Steve, I'm good. I'm ready for my purpose-driven passive profits round. Let's do this, man.
Awesome. So we're going to be talking about interest rates today. A lot of people, there's some articles coming out. There's a lot of chatter in the marketplace about interest rates are going up. Liquidity is going down. The Fed is pulling money out of the market. People are saying, if you buy a multifamily building right now, you are going to be in trouble 3 to 5 years from now when you have to refinance out. Or you've been hearing about commercial buildings rather going downhill because people are moving out. Why, if you're looking at investing for passive income in multifamily buildings, why is right now probably the safest time in history for us at least?
Yeah, so a couple things. I want to kind of take us to a 10,000-foot view in this, Steve. So we all saw the big bank collapse. There's been 2 of them. There's a third one that had to be shored up. And it caused the Fed to jump in and do a little bit of a temporary bailout. And then they said, we're not going to bail out anybody else. It's kind of what their words were. And so now what's happened is there's been a liquidity crisis. People, the Fed including, is pulling money out of the market. Individuals are pulling money out of banks. So then there's less money to be made as loans to real estate people. And as the recession deepens, what the fear is for people in commercial real estate and single family houses, what the fear is that a lot of the demand's going down, and then therefore what will happen is people will go to refinance their loan in 3 to 5 years, and then there won't be enough liquidity for it. There won't be enough new loans. And that's a very valid fear. So I'm glad that people have that question. Here's the biggest hedge against that. Take out long-term fixed debt. I know it sounds like a pretty easy, simple solution, but literally what we're doing right now, what this means, we have a deal that we're entering contract on right now, going through our due diligence process, that has a 4.3% fixed 30-year term loan on it. And so what we recommend for anybody else that's doing this business out there is go for a long-term fixed debt. Don't take the short-term things. Don't think that 2 years from now, loans are going to be in a better spot. Take long-term fixed debt. No different than you would if you were going to take out a loan for your personal house.
Okay, Nate, so what I hear you saying is this is actually a pretty easy fix. Just make sure that you're taking a long-term 10, 15, 30 years and make sure that it is a fixed rate. Why in the world would anyone take a adjustable rate loan right now looking at what's going on?
Yeah, the reason that people are taking adjustable rates is because rates are high. They're 6, 7%, whatever it is, depending on the vehicle you're trying to get into and the bank you're working with. So they take this rate thinking, you know what, in 3 years, 5 years, rates are going to be lower and I'll just refinance out. The problem with that theory, rates might be lower, but there's going to be less lenders lending money. It's going to be much higher credit criteria. It's going to be much higher criteria for net operating income in a property. And so you have to keep that in mind. Today, there's still some money flowing out there. There's money that's out there to be had for loans. But in 3 years, there might be less. In the middle of a recession, there's always less availability of credit. And so that's the big deal. That's why.
Okay, that makes perfect sense to me. The other thing that I think, I mean, if you take long-term fixed debt, even if you pay slightly higher right now, if the rate is lower in the future, you can always then refinance. It's better to have locked in to me. Let's talk about actual numbers. How is this going to represent itself to somebody investing in one of our deals? If we had a deal that we put in front of somebody and we say, hey, it's long-term fixed debt, not a short-term adjustable, how does that impact the bottom line?
Yeah. So the bottom line is this. Number one, we're going for loans that are way less than today's market rate by trying to take over the existing. One thing, and this is something that I failed to mention in the beginning, is that we know how to get directly to a seller. We don't have to go through the broker. We don't have to go through CoStar or LoopNet or any of the other big listing platforms for these commercial deals. We have a marketing platform. Steve and I work on this all the time, called Social Media Blueprint. And so we know how to get directly to the seller. And so a lot of times when you're working directly with the seller, you can ask the question that you can't ask when there's a broker involved. Hey, can you tell me about your existing loan on the property? How many years ago did you take it out? What interest rate was it? And when we hear the magic words like, oh yeah, I took it out when interest rates were really low, it was 3% or 4%, then we get really excited on our side. And so that's what we're able to do oftentimes is we're able to take over the existing loan that's on the property and not have to deal with today's higher interest rates. So back to your original question, Steve, what's the bottom line look like for investors? It's really, really good. It's better than most people would get for IRR or rate of return because we're getting such a low debt amount or low debt payment each month coming out on the profit and loss statements.
Awesome. So, Nate, there are two questions I have. The first one is, do they allow you to easily assume loans on multifamily? I've heard of doing it on single families. I've heard of doing it on duplexes and triplexes, but on a large multifamily, will they let you assume the loan?
Yeah, so it's not super easy as you just asked. We get it done. Here's why we get it done. Resume, they want to see that you've got other multifamily property. They want to see that you've got a good long track record of successful cash flowing properties. That's most important to them. Number two, they check credit. They want to know that. Number three, they check assets. They want to know like, hey, outside of this property, if something gets bumpy, do you have the assets to do this? And so that's what we do on our side as the sponsors for the deal. We're also the sponsors for the loan. They underwrite us. As our investors come in, our investors don't have to do any of that stuff. They don't have to sign anything with the bank. They don't have to have credit scores pulled or anything like that. That's just for us on the management side of the deal.
Awesome. That clears that up. So it is possible, and it's not the same as assuming a single family or a duplex in the fact that you're just writing a letter to the bank. This is actually you going to the bank and you're going to be on the paperwork and you are actually holding the loan. They're checking you out. They're checking your credit. They're checking your properties. That tees up the property that we are getting ready to offer. Nate, do you want to talk about this sweetheart of a deal?
Yeah. So this is a smaller deal. It's only a couple $1,000,000, and we don't need very much cash for it because we're assuming the seller's existing mortgage on the property, literally at 4.3% interest rate. This is an absolute home run. Much of it driven by that interest rate that's on the property right now. The second part of it is it's literally right around the corner from another asset that we own in the same market in the great state of Kentucky. So very landlord friendly, economy's still really strong. We're raising rents very aggressively on other properties. So our management team is excited about this asset too. So spots on this one, they're going to fill really, really fast because it's a smaller deal. So if you have interest in looking at a deal, I'd highly recommend you come back to our website, come check it out in the show notes or homeinvest.com, and you can come take a peek at this deal. We're happy to show it to you while it's there.
Awesome. That is homeinvest.com. It is in the show notes under this. You're also going to hear a quick blurb about it. If you are interested, these spots are going to go really quick because cash flow and IRR is high on this. It is a great deal. So make sure to check it out. Next time, we are going to be talking about IRR specifically, what you should do with the marketplace, how you should do your due diligence on people who are offering you deals. Until then, though, make sure you check out the property below, and we will see you next time on Purpose Driven Passive Profits. Thanks so much for listening to our show today. Here's Nate with our latest offering.
Oh, so I'm excited to announce this. We've got a 78 unit building, multifamily property. It's 5 minutes from the Kentucky Derby. Its rents are presently 20% below market for renovated units. To learn more, all you need to do is go to homeinvest.com or click in the description below.